Listen to the sound of $1.6 trillion resetting in total silence, while your nervous system screams at a screen that isn't actually moving. The best way to think about this is a digital phantom. The core frequency of global wealth just shifted. You are watching a ghost on a screen, while the actual capital migrates to a secure off-chain vault. This is not a temporary setback. It is the first stage of a total structural reset. Your conviction is being weaponized against your liquidity. While you celebrate a 2024 narrative, the 2026 Institutional Ballast has already locked the gears. You feel the invisible friction of a settlement layer that is outperforming the world's largest credit networks, even as your screen turns red. The floor is solid. The press is moving. You are currently positioned in the direct path of an asymmetric hydraulic press that was built specifically to extract your patience. The exit door is not just locked. It is being welded shut by the very math you claimed to trust. The sweat you exert to time the 1-minute candle is the primary lubricant for the mechanical gears currently grinding against your net worth. You believe your intuition is a shield, but the architecture of the 2026 market recognizes your pattern-seeking brain as a raw energy source. The best way to think about it is like a ship in a storm being stabilized by lead. The halving-centric linear cycle is the bedtime story they told you to keep your behavior predictable in a post-Genius Act world. You are waiting for a 4-year rhythm that has been permanently disrupted by the arrival of the institutional ballast. It works in 3 simple steps. First, you build the wall. This is the institutional ballast, the concrete blocks in the hull of a ship that stop it from flipping over when the retail waves get choppy. Spot ETF flows now move 12 times the daily mining supply during every single US trading session. Second, you plant the trees inside the garden. Relying on the halving as a price driver is like checking a thermometer while the building is being demolished by a wrecking ball. It is a systemic liability. This obsolete logic ensures you stay positioned in the soft retail zone of the press, waiting for a surge that has already been neutralized by the off-chain migration. It's like moving from driving your own tractor to just owning shares in a farming conglomerate. And third, the most important step, you own the only gate into the garden. The current price discovery phase is an asymmetric hydraulic press. It is designed to apply a slow, agonizing compression to speculative debt until the market structure is purified of all weak links. More effort creates more friction, and more friction creates the heat required to melt your leveraged position into liquid exit liquidity. Bracing against the descent only increases the structural load on your capital. Audit the capital inflows of the prior decade to witness the structural reset of the global settlement layer. Since late 2022, the network has absorbed $732 billion in new, regulated capital through institutional channels. This figure exceeds the cumulative inflows of every prior market cycle since the Genesis block combined. We have moved from a narrative asset to a high-beta tech proxy, like the QQQ but on high-grade steroids. This recalibration is the primary function of the derivative leverage feedback engine, the mechanical plumbing that allows $734 million in debt to vanish in a single 24-hour cycle. It is a cold system that exists to purge the excitement of the speculative tourist and reassign value to the patient. It only recognizes the realized cap equilibrium, the pawn shop value where everyone actually bought in, ignoring the sticker price on the window. This engine performs a direct extraction of your wealth to subsidize the entry of the next sovereign wealth fund. Your struggle provides the exact kinetic energy the machine needs to achieve a total structural flush of the retail cohort. Your effort is the engine's fuel.
Why is the very instinct to preserve your existence within this architecture the precise reason you were selected for mechanical liquidation? The press doesn't move because it's malicious, it moves because your survival instincts provide the pressure necessary for its calibration. Survival is debt. In October 2025, a senior analyst in an Austin high-rise watched the 1-minute candle at 3 in the morning. The sandpaper grit of unblinking eyes became a physical weight as he misread a structural deleveraging event as a wobble. He added margin. The sterile, ozone-heavy aroma of a laptop fan hitting maximum capacity filled the air as the price nuked towards 60,000. This was the 126K trap. He discovered that fighting the machine only provides the friction it needs to grind your capital into exit liquidity. He was liquidated. In a garage in Ohio, a worker feels the sub-bass thrum of 800 exahashes per second vibrating through the floor. He checks his phone and feels the metallic taste of cold coffee as the MVRV divergence opens into a hollow abyss. It's the gap between how much you think your house is worth and what a bank would actually lend you. Confidence is extracted. Your brain is hard-coded to flee from predators, but the system recognizes this adrenaline as a high-value and predictable raw commodity. It creates a state of chronic cortisol to ensure you remain trapped in the adrenaline-induced liquidation reflex during every structural reset. Panic is fuel. In early 2026, 160,000 unique nervous systems were flushed from the market in a single 24-hour window. This biological mass extraction resulted in $734 million in mechanical liquidations. The machine does not hate your biology. It simply needs your exit liquidity to balance its own books. The purge is mathematical. Your perceived failure to execute is not a character flaw, but the precise intended systemic outcome of the machine's architecture. Weakness in the individual is the ultimate strength of the derivative leverage feedback engine. Become the error. Emotional reaction is the only currency the system accepts for payment. Cold, non-reactive alignment with the code is the only detectable error in the current market loop. Reacting is surrendering.
The invisibility of the mechanism was its only source of power over your trajectory. Once the internal geometry of the press is mapped, the predator loses its ability to camouflage within the volatility. You are no longer a component being processed by the derivative leverage feedback engine. You are the strategic allocator, an operator who views the system not as a threat, but as a predictable high-yield environment for capital reassignment. The mechanism is now visible. Use it. It works in 3 simple steps. First, you build your own wall. To neutralize the adrenaline-induced liquidation reflex, you must deploy the realized cap filter. Stop calculating your position based on the $61,000 sticker price currently flashing on the exchange interface. Anchor your conviction to the $54,920 aggregate cost basis. This is the realized cap equilibrium, the pawnshop value representing the price where the global capital base actually entered the network. If the market price remains above this pawnshop floor, the bull trend is structurally healthy, regardless of the noise. Execution is the only armor. Second, you plant your own trees inside the garden. Your second directive is off-platform liquidity extraction. You must starve the feedback engine by removing the raw material it requires to function against you. Move your assets to non-custodial control, bypassing the regulated brokerage internalizers that profit from your inertia. This is the end of the off-chain migration, moving from driving your own tractor to simply owning shares in a farming conglomerate. In your Austin apartment, as you watch the 9% interest floor compress the local tech lease market, remember that your sovereignty is tied to what you physically control. And third, the most important step, you own the only gate into the garden. The third countermeasure is volatility arbitrage. Treat the 0.80 NASDAQ correlation as a strategic gift rather than a correlation trap. Bitcoin currently functions as a high-beta tech proxy, like the QQQ but on high-grade steroids. When the legacy tech sector panics, the asymmetric press overreacts, creating a temporary MVRV divergence. This is the gap between how much you think your house is worth and what a bank would actually lend you. A strategic allocator doesn't fear the overreach. They identify the math and buy the friction. Using the enemy's gravity allows you to accelerate your own accumulation while the retail cohort flees. The system's logic is your propulsion. As an operator, you must now perform a final strategic audit of your own survival architecture. The Bitcoin network settled $6.9 trillion in value over the last 90 days. Functionally, this math-based ledger is now outperforming the quarterly settlement volumes of both Visa and MasterCard. Is your net worth a function of human fiscal policy, which requires a promise, or cryptographic math, which makes a promise impossible to break? Your answer determines your trajectory.
The structural recalibration you see today is the opening act of a decade-long compression. Total fiscal liquidation is not an abstract theory. It is the mathematical gravity of rising sovereign debt levels. A 1-degree tilt in your fiscal floor today creates a vertical wall within the next decade. If your strategy is to wait for the storm to pass, you have misunderstood the nature of the weather. Neutrality is not a safe state. It is an active choice to be slowly liquidated by the system while you wait for a consensus that will never arrive. In 2026, those who remain soft capital are already being compressed to subsidize the entry of the new sovereign class. As the asset architect, your trajectory is no longer tied to the decaying promises of human fiscal policy. You have moved beyond the extraction zone of the derivative leverage feedback engine. You have transitioned from being a component of the press to the sovereign operator of the ledger. By 2035, the Compute Energy Singularity, the Stargate initiative, will link your holdings directly to the survival of the global AI infrastructure. You are no longer a passive resident in their architecture. You are the landlord of the code. But the next layer of the press is the illusion of abundance. While the institutional ballast continues to anchor the network, the window for fractional sovereignty is narrowing at an accelerating rate. To understand why owning 0.1 BTC is the final threshold from escaping the permanent subscription class, we must audit the deterministic scarcity of the 21 million cap. The math is cold, absolute, and non-negotiable. The key was melted at the bottom of the ocean. Volatility is not a systemic failure. It is the essential price of discovery.